My title today is "The Fiscal Engine is Failing and Bitcoin is the Spark." We had a really big week last week, especially when it comes to economic data. We got to see a lot of what's under the hood in the macro environment with the fiscal situation in the US. And if you guys did notice, Bitcoin fell a little bit. Stocks fell a lot a bit.
All right, that's the headline. Today, we're breaking down why U.S. debt markets just flashed a big warning, how the White House's new crypto pivot fits in, and what it might mean for Bitcoin, stablecoins, and your portfolio. The U.S. Treasury now expects to borrow about $1.007 trillion in Q3, and that estimate is $453 billion higher than what they said in April. Translation? Bigger than expected funding needs right now. Treasury itself says the jump is because of a lower starting cash balance and lower net cash flows. But the market read was simple. Liquidity is coming. When you load the bond market with more paper and buyers don't instantly show up, yields go up, prices go down. Bond math 101.
Bond prices and yields move oppositely. If yields go up, bond prices go down. Okay? Now, if you just think about that for a second, it's actually very intuitive, right? If the U.S. needs to strum up more demand for its debt, they pay you a higher yield. If the U.S. says, hey, we're looking to borrow $450 billion, and everyone says, cool, how much do I get paid for that? And they say, 1 basis point. Everyone says, oh, screw that. Okay, what about 2 basis points, 3 basis points, 4 basis points, right? And so the point is, yields go up, bond prices go down. The higher yields are, obviously, is going to tell you that there's less interest in lending to the government. If everyone was head over heels interested in lending capital to the government, and they're willing to pay any price, it doesn't matter. They just want to lend to the greatest country on earth. Well, then the U.S. wouldn't have to pay them that high yields. If the U.S. can't find a lender, then yields are going to go up, which means the price of a bond goes down.
And we saw classic risk-off ripple through equities that week. Stocks slid, then chopped. Macro shops framed it as tariffs, plus soft jobs, plus funding needs, colliding in a historically choppy August. Jack Mallers argues there aren't enough natural buyers anymore. Less China, sanctions on Russia, hedge fund basis trades, not what they were. Setting opinions aside, the hard fact is the government needs big, steady sources of demand. 2 levers stand out. 1, push the Fed to cut, cheaper borrowing. 2, grow new buyers, and that's where stablecoins and tokenized cash come in.
The Fed needs to cut because the Treasury is flooding the market with debt, and foreign buyers aren't stepping in. If the Fed doesn't absorb the pressure, yields will rise, which means bond prices will fall, liquidity tightens up, and everything sells off. Again, this is what we saw late last week. So the biggest news from last week is when we realized, holy smokes, yields rose, bond prices fell, and the Treasury didn't even issue all the debt it needed to. It's trying by the whims of the tip of its fingers to hold on for dear life. And they still can't figure it out. No wonder, guys, no wonder they've been hammering Jerome Powell. Now it makes, how much sense does it make? It makes all the sense in the world. Hammering Jerome Powell. Hammering this guy. And so they need the Fed to cut aggressively, like overnight. Or they need stablecoins to explode in growth. They need to find new dollar demand, new demand for the debt. Okay? That's really the point. So, what do we see as a result of this? Well, the hammering of Jerome Powell will continue. It will not stop. If anything, it's going to just get worse. One way out of this is to reduce the cost to issue debt. If they can get rates to as close to zero as possible, then issuing debt is free. It doesn't cost anything. They are going to hammer this guy. Hammer him over the top of the head. They're going to try and embarrass him. They're going to try and find ways like irresponsible budgeting for his new office or whatever to try and kick him out.
Pressure on chair. Jerome Powell is now very public. On August 1st, President Trump urged the Fed's Board of Governors to strip powers from Powell if he won't cut, and he's openly welcomed Powell's resignation in interviews this summer. Meanwhile, the White House launched an official crypto page and started pumping out policy docs that frame digital assets as a national priority. Yes, that's a real URL.
There is now a website on the whitehouse.gov website. There is now a domain, whitehouse.gov/crypto. This is not a drill.
This wasn't just a web facelift. Congress passed, and the president signed the Genius Act in mid-July, the first federal stablecoin framework in the U.S. It sets one-to-one reserve standards, clear oversight, and mechanics like freeze/comply capabilities for permitted issuers. That's Washington building pipes for tokenized dollars. Let's talk stablecoins. Tether's Q2 attestation says its total U.S. Treasury exposure topped approximately $127 billion, about $105.5 billion direct, plus $21.3 billion indirect. Like it or not, that makes Tether a top-tier buyer of treasuries now.
They now hold over $127 billion in U.S. treasuries. They are now one of the most active lenders to the United States of America.
At the same time, Goldman Sachs and BNY Mellon rolled out a tokenized money market solution, basically turning traditional MMF shares into blockchain-recorded assets. Why it matters: money market funds are over $7 trillion today. That's a massive pool that can be modernized without reinventing the underlying products. If even a slice of that gets tokenized, faster settlement, programmable collateral, 24/7 rails, you've just created structural demand for short-term treasuries via digital wrappers. That's the new lender's lever Jack Mallers is pointing at. There's also the Treasury buyback lever. Late July, Treasury said it would boost quarterly buybacks of older notes bonds to $38 billion and double the frequency for certain tenors. It's technical, but the gist is smoothing liquidity in off-the-run bonds and managing funding profiles.
Treasury Department will boost debt buybacks from the Wall Street Journal. We heard a lot from Besson earlier this year about the tactics he was going to use to help the U.S. government survive and fiscally afford itself. We heard Treasury buybacks. We heard the supplemental leverage ratio. We've heard it all. And he talked about how these things would start to come to fruition over the summer and early fall because he needed to negotiate trade deals first. Those trade deals are starting to come due. You've seen a lot of that. Trade deal with Europe over the last week came due. Now you're starting to see, here's how this works, guys. If you can't win the game, change the rules.
Now, the spiciest idea in the episode: Bitcoin as a liquidity sponge. If policy runs the economy hot, cuts liquidity easing, the argument is that some of that flow gets absorbed by BTC/stablecoins instead of spilling into CPI goods and services. That's a thesis, not a law of physics, but you can see why policymakers might be comfortable growing digital dollar rails and not fighting Bitcoin head-on right now. Markets have been jumpy. Stocks sold off the first week of August, then rebounded. The dollar logged its best month of 2025 in July, then wobbled after weak jobs. This tug of war is exactly what you'd expect when funding needs are high and policy is in flux. Here's your near-term checklist. 1. Treasury funding cadence. How third-quarter auctions and cash balances track versus that $1.007 trillion guide. Any revisions in November's refunding documents. 2. Powell pressure and Fed path. Public calls to curb his authority or replace him. Watch FOMC guidance and nominations chatter. 3. Stablecoin flows, growth in USDT, USDC market caps and disclosures, tokenized MMFs pilot adoption. 4. Buybacks and bills versus coupons mix. Whether buybacks expand further, effects on off-the-run liquidity. Big picture, funding needs are up, pressure on rates is real, and Washington is actively building digital rails. Genius Act, a White House crypto page, tokenized money markets. In that world, it's rational to expect stablecoin treasury demand to grow and Bitcoin to remain a political and financial talking point, even as prices zigzag in the short run. Agree or disagree with the takes? The data is the story. $1 trillion to finance this quarter, $7 trillion plus in token-ready money markets, and six-figure Bitcoin living rent-free in DC. We'll keep tracking the numbers, not the noise. If you enjoy the video, please consider a like, subscribe to the channel, and leave a comment with your thoughts. As always, I will see you next time.